Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 8K filing. It might sound like a droid from Star Wars, but trust me, it's got way more financial drama. We'll see if this company's performance is worthy of a standing ovation or if it deserves to be thrown into the financial pit of despair. In short, this report tells us that Ampco-Pittsburgh Corporation, a company with a funny name, released its financial results for the year ending December 31, 2024. It's basically a peek behind the curtain to see how much money they made or didn't make. This report is dated March 12, 2025, meaning that's when the event they are reporting happened. The company we're looking at is called Ampco-Pittsburgh Corporation. They're located in Carnegie, Pennsylvania. They were started or incorporated in Pennsylvania. Their main office is located at 726 Bell Avenue, Suite 301, Carnegie, Pennsylvania. If you want to give them a call, their number is 412-436-4400. The company has common stock, which is what you can buy on the stock market. It's listed on the New York Stock Exchange under the ticker symbol API. They also have some Series R warrants, which allow you to buy the company's stock under certain conditions, which trades under the symbol APWS on the NYSE American LLC exchange. Now we get to the important stuff, the financial results. On March 12, 2025, they put out a press release about how they did for the last 3 months and for the whole year ending in December 2024. You can find the actual press release as Exhibit 99 attached to this report. This is where all the juicy numbers are hidden. Now let's get down to brass tacks. Let's break down what this all means. I went ahead and looked at that exhibit that they referenced so we wouldn't have to go digging for it ourselves. This table contains the income statement and shows how profitable the company is. Let's see if there are any numbers that pop out. First, we see net sales in 2024, that's $344 million. But in 2023, it was about $37.2 million. That's about a $28 million difference, which means they had less sales compared to the year before. The cost of products sold, also known as cost of goods sold, was $288 million in 2024 and $315 million in 2023. This means they also paid less for their production compared to the year before. Gross profit is the money left over after subtracting the cost of goods sold from net sales. The amount was $56 million in 2024 and $57 million in 2023, so slightly lower. This isn't a good sign. It means less sales and lower profits. Selling, administrative and engineering expenses were $56 million in 2024 compared to $54 million in 2023. This means they spent more money on these things, so that affects the bottom line negatively. Operating income, which is what's left over, before considering interest and taxes, they lost $150,000 in 2024, while in 2023 they made a profit of $3 million. This means the company is not as profitable this year compared to last year. The interest expense was $4.1 million in 2024 compared to $2.8 million in 2023. That's a big jump. Interest expense is the amount of interest that the company has to pay on its debts. This can be a problem if the company is struggling to make profits. Income before income taxes shows that they lost $4.3 million, while they made a profit of around $200,000 the year before. Finally, net income, the bottom line, ended up being a loss of $4.3 million in 2024 and about $100,000 profit in 2023. This means the company lost money this year. Not a great year for them. That boils down to losing 40 cents per share of stock, compared to them making only 1 cent per share the year before. Now let's dive into their balance sheet. This will show us how much they are worth. First, cash and cash equivalents were $15 million in 2024 and $18 million in 2023. This means they have less cash on hand compared to last year. Accounts receivable, the amount of money that's owed to them was $41 million in 2024 and $45 million in 2023, so it went down. Inventories were $87 million in 2024 compared to $85 million in 2023. This shows they are holding more inventory than before. Total current assets are what the company can use in the short term and was $160 million in 2024. Compared to $165 million in 2023, it went down slightly. Property, plant and equipment was 120.24 and 2020-24 and 120.23 went down a bit. Total assets were $310 million compared to $320 million the year before. This means the company has less assets than before. Let's look at liabilities and equity. Accounts payable. The amount of money the company owes to others was $19 million in 2024 and $18 million in 2023, so slightly more. Accrued expenses was $25 million in 2024 and $23 million in 2023, so it went up a bit. Total current liabilities, which is what the company owes in the short term, was $67 million in 2024 compared to $66 million in 2023. Long-term debt was $92 million in 2024 and $96 million in 2023, so it went down. Total liabilities was $160 million in 2024 compared to $16.2 million in 2023. Common stock was $10 million in both years. Retained earnings were $140 million in 2024, but Honford ate $8 million in 2023, so it went down by $8 million. Retained earnings is the amount of profits that the company has kept over time. This decrease is because of the company having losses over the past year. Total equity. The amount of the company that is owned by the shareholders was $150 million in 2024 and $158 million in 2023. Total liabilities and equity, which should equal total assets, was $310 million in 2024 and $320 million in 2023. So Ampco-Pittsburgh had a rough year. Sales were down. Costs were up in some areas, and they ended up with a loss instead of a profit. Their assets also decreased slightly. It's a mixed bag, but the overall trend isn't exactly sunshine and rainbows. They need to figure out how to boost sales and manage their expenses better. The report was signed by Michael G. McGauley, who is the Senior Vice President, Chief Financial Officer, and Treasurer. So it's a real deal. In my opinion, Ampco-Pittsburgh is facing some headwinds. The decrease in sales is a major concern and they need to find a way to turn things around. Their interest expense also jumped up, which is never a good sign. However, they still have a good amount of equity, so they're not in immediate danger. But I would definitely keep a close eye on them. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. What company should we decode next? Let me know in the comments.